Welcome to episode 96 of Live with the Maverick. My name is Dominic Lee, founder of Maverick Actuary. We are a content community. Our mission is to maximize the impact and value of quant professionals on a global scale. The goal of this series is to educate our community on the most relevant themes in actuarial science, risk management, and analytics. The theme of today's discussion is excess casualty. And we are very excited to have with us our guest for today's episode, Don Grimm. Don is Principal and Consulting Actuary at Archer Actuarial Consulting. Welcome, Don.
Oh, thank you, Dominic. Great to be here.
Great to have you, and good to see you posting one of the few active posters on LinkedIn in the actuarial community. So that's how I kind of caught wind of Don and thought it would be good to reach out. This is a topic that I think is very interesting. And one of the topic, one of the things we try to do on the podcast is talk about some of the topics that, you can't just easily Google that sometimes require some more involved discussion. So I think this will be a very interesting conversation. So good to have you, Don, and just love to give you an opportunity to introduce yourself.
Yeah, likewise. So my name's Don Grimm. I'm an actuary. I've been an actuary working in the field for about 30 years. I got my start at Cigna, which is now part of Chubb, kind of by accident. I feel like back then a lot of actuaries didn't necessarily go to school to be an actuary and kind of fell into it. I got lucky because I was a math major, really not knowing what I wanted to do. And there was a part-time job posting at my college, and I applied for it. And it turned out I was the only one that applied for it. And I got a call a couple weeks later, and they said, "Well, we didn't think you're very qualified, but you're the only one that applied." So that was fine with me because it was like twice what I was getting paid, whatever I was doing. So that was my beginning in the actuarial field, and then I started there full time after college, and kind of moved around between insurance companies and consulting, and mostly in loss reserving. My most recent role in the insurance industry was as chief reserving actuary for Harleysville Insurance. And then 7 years ago, almost to the day, I started Archer Actuarial Consulting, and it's been quite an adventure. I've learned a lot and doing a lot of work that I didn't expect to be doing. So it's been really fun.
Yes, I always love hearing about the stories about how everyone got their foot in the industry. I think they're very different depending on the person. So hey, however you get your foot in, doesn't matter, right?
Exactly.
Yeah. So you mentioned that of course, you have extensive industry experience, and you were in a few different companies, and now you have, I think, your own consulting shop. So what got you into independent practice, and how do you describe your current role and your company?
Yeah. So I had worked in consulting, and having my own practice was something that I always wanted to do. It was kind of always in the back of my head. It really took a lot of confidence to be able to go out on my own and start my own thing. And for anybody interested in doing that, it's very rewarding and also very challenging. And I still remember the time that I sat down to work on a project for my first client and opened a blank Excel worksheet. It wasn't like, well, let's update some other project. It's literally like a blank, a blank sheet. And so it's kind of building from the ground up. So yeah, at Archer Actuarial, I provide kind of your typical P&C actuarial consulting services to insurance companies and self-insureds. And I've gotten to work on a lot of interesting things. I did some expert witness testimony last year in a criminal trial, which is very interesting. And I support one of my clients is a telematics provider. So it's kind of not your typical standard actuarial work, but a little outside the norm, but you still get to apply a lot of the same principles. So yeah, and what's happened most recently, you mentioned the LinkedIn posts. I just started posting some basic actuarial 101 type of stuff on LinkedIn because I've found that if you're a non-actuary and you want to learn a simple actuarial concept, and you Google it, you're probably going to get like a paper from the CAS, Casualty Actuarial Society, and it's going to be very complicated, and you're probably not going to read it. So I recognize, well, there's a niche here for just sharing basic actuarial 101 information. And I've kind of parlayed that into some training opportunities where some companies have reached out to me to provide just basic actuarial 101 training for non-actuaries so they can understand the principles without, having to go through the technical process.
And I love that last point because, and we spoke about this in the pre-meet, is that, and that's honestly one of the reasons for the podcast as well, is I found that there's a gap, a content gap in the actuarial market where, like you said, you can look it up online, but you're most likely to run into a very technical paper. So when you want some of these concepts explained in very plain spoken language, that I found to be a challenge. So I like to think that's one of the gaps that we're trying to fill, especially for some more nuanced topics like excess casualty,
Yeah, absolutely. And what's interesting is, just from my perspective, from sharing this type of information, even though it's, typically basic actuarial information, when you're tasked with explaining it to somebody that doesn't understand, maybe all the fundamentals, you really, really have to understand it yourself and be able to digest it and express it in a way that somebody that doesn't have all the information you have can understand it. And so through that teaching process, I've learned a lot, and it kind of surprised me from having worked in the field for so long. You get to the point where you kind of feel like you know everything, but just explaining things in different ways is rewarding in itself.
Especially when you have to put in short form, right? I
Yeah,
could imagine that's a challenge. I mean, for anyone, that would be a challenge. Yeah.
exactly.
So that's
It's easier to write a long paper about a topic than it is to write a short one.
yeah. So yeah, that's one of the challenges I like with LinkedIn too, is to your point, when you have to explain something in a short enough version that it will still hold people's attention and you're not writing too long. You have to be very succinct, and like you said, you have to really understand the topic. So I think that's a good skill for all, not just actuaries, but for professionals to have.
Absolutely.
Yeah, so let's get into the topic. So excess casualty, very fascinating subject, and I imagine that certainly people who've been in property and casualty for some time may be familiar with it, but a lot of the viewers, whether they're younger viewers or people in other disciplines, may not be as familiar with it. So how would you describe excess casualty?
Yeah, so excess casualty or excess liability, just the same name for a different thing. It's just another type of insurance coverage that property and casualty companies offer. It's usually on an occurrence form, and it's designed to extend the limit from an underlying coverage. So if you purchased an auto liability policy and you have, say, $1 million limit, but we all know there can be accidents that wind up costing more than $1 million, and you don't want to essentially self-insure that yourself. You would go and buy an excess policy, or that's one of your options. And you can add typically, I'm not going to say as much limit as you want, but most major companies will offer an additional $25 million of limit. So you're essentially extending the limit of the underlying primary coverage. And that can be for auto, it can be for general liability, workers' compensation, some of the professional liability lines.
Mm-hmm. No, the natural extension of that question is, and I'm reminded of this, is like when you think of insurance, when the average person thinks of insurance, if you're not an expert, if you're more just like a personal lines purchaser of insurance, wrapping your mind around the need for limits greater than $1 million, that's certainly foreign to many people. And I remember one story is when I was in my first company, we were doing a group project and we were working with people in different disciplines. And I think it was someone in operations. They were either in operations or finance. And I was telling them about a claim. This is a property claim that I came across, which was like 114 million. It was a property cat claim, of course. And they couldn't wrap their mind, even though they were working for the company, they thought I was joking. They didn't think that you could have a claim of that size. And of course, that was property, but similar concept. So, the natural question is like, who needs this type of coverage? Which individuals, which class of business, which type of clients, who needs like these kind of limits?
Yeah, so excess is mostly for commercial insurance. There's a similar concept we can talk about, umbrella, which is more for personal lines, not exclusively, but it tends to
Yeah.
be that way. So pretty much any business, um, they do have so primary limits tend to be up to $1 million. All right, those are broad statements, but typically, if you bought a workers' comp, or well, not workers' comp because there's that's unlimited, but general liability policy, it's going to be $1 million limits. So if you're a business, somebody slips and falls, or the auto exposure, it's easy to have exposure over $1 million, especially in this environment with, you hear of nuclear verdicts and just kind of crazy outcomes. $1 million doesn't sound like a lot of money compared to some of the outcomes. So to answer your question, pretty much any business really needs to insure over $1 million, unless they're small enough that they're just going to kind of take the risk that if we get a claim bigger than $1 million, maybe that's the end of our business. And sometimes that's a calculated risk that a company is willing to take. But any medium or large size business, they have to do the kind of the cost benefit analysis and take that a little bit more seriously.
Would you say that there's also an industry dynamic to that? So do you see any like whether you want to call it a bias, or do you see some industries purchasing it more than others, and also maybe geographically? I know, for instance, liability in the US tends to be more of a thing than in other parts of the world. So when you think of industry and geography, do you see any that are any areas where it's more common than others?
As far as the industry goes, I mean, I think it's mostly pretty proportional to the type of to the risk. So, like as an example, for auto, if you have a business where kind of an extreme example, you're a fuel delivery business, um, you know, that's a much higher risk profile than if you're Uber or something. Either one of those people could get in an accident. It results in more than $1 million of damage. But if you're driving a fuel truck and, they're big, heavy vehicles that can explode, that's much more risk. So I guess I would say typically most companies that purchase excess and the limits that they're deciding to purchase, there's some consideration of their actual exposure to very large losses, because at the end of the day, excess is designed to cover very large losses.
Mm-hmm. Yeah, that's helpful. Now, when we take a step back, when I think of different lines of business, we've only done one other line of business episode, but I think it's helpful to think of the broader market as you would with anything else in the economy. So when you think of excess lines, excess casualty, what does the market for excess casualty look like today?
Well, the rates are going up dramatically. Um, and maybe we can talk about this in a bit, but like in the LinkedIn post, I referred to excess casualty as extreme insurance, because pretty much all aspects of it, all of the risks that you underwrite when you write a policy for P&C insurance, all of those risks are exaggerated when you're talking about excess insurance. The and there's also this, so you have the potential for much larger claims, and there's also a lot of latency. So you could be incurring very large claims and not knowing about them for many years, actually. So, well, I forget the original question.
Yeah, it was just more like the market when we think of, like you said, you were talking about whether it's hard or soft. You said that it sounded like there was a hardening of the market. Like what does capacity look like? Just a couple of those fundamental things.
Yeah, thank you.
Yeah.
Yeah, so the rates are going up pretty dramatically in the market. And I think we all kind of know inflation has been a big deal the last few years. And then there's this period where the insurance companies are kind of catching up. So we're still seeing big rate increases, say, in the auto side, so auto liability. Well, excess by its nature, it has even more latency. And by that, I mean, so if you had an auto claim you're probably going to know about it. If you had a really big auto claim, you're going to know about it pretty quickly, and you're going to be able to respond to that if you're an insurance company and build it in the rates. But excess, you don't really know what's happening in your current portfolio because there's so much latency. So what I'm seeing is very large rate increases because there's this leveraged impact of inflation in the excess layers. And there's this lag. It takes insurance companies a little bit longer to actually see what's happening in the portfolio and then decide, okay, we have to raise the rates by a certain amount to become profitable again. So it's a tough market right now, and there's a lot of forces, inflation, social inflation, all the pressure from litigation that are all kind of the perfect storm that are increasing rates. I think there's still a decent amount of capacity, but you know, the excess carriers are definitely looking for more money, and they, you know, the results seem to indicate that they need to do so.
Great, that's a good overview. One of the things I noticed, actually, we spoke about this before, is I actually did an article on excess and surplus. So that would include surplus lines, which is, for those of you who may not be familiar, you know, insurance for like when you can't get it in the standard market. And I actually took a look at the market in terms of, they looked at the ratio of the direct written premium for excess and surplus combined over the standard market, and they found that the ratio was increasing in the most, I think, 5 recent years. And you know, so I was just curious about that, like how much, and you raised a good point in that some of that could be that the disproportionate rate increases, but also some of it could just be that there's less capacity in the primary market. So I think you know, that's an interesting observation. And like I said, that was for both excess and surplus. So it sounds like, you know, specifically for excess, it could be one of those two things or both.
Yeah, I think all those factors are contributing. And if you think about the impact of inflation, it just keeps pushing more and more of the exposure into higher layers. So just over time, if you know, we tend to keep this $1 million nice round number as a primary limit. So that's like a fixed amount. But over time, $1 million isn't what it used to be. So a higher portion of the total loss keeps going into the excess layer and less in the primary. And when there's low inflation, that tends to be hardly noticeable. But more recently, it has more of an effect.
Yeah, good. Now, you did talk about umbrella insurance earlier, and I think this is a really interesting one. You know, when we think of excess casualty, it has similar attributes to umbrella insurance for primary lines and even reinsurance as well. So let's start with umbrella. You know, what are the key differences between excess casualty and umbrella insurance?
Yeah, okay. So excess casualty, I would say it's more for commercial lines. It's so it's more of a business focus. And it's primarily designed to extend the underlying policy limit. So it doesn't provide a broader scope of coverage. It just extends the limit, generally. Umbrella, on the other hand, that can be for commercial lines, but you might hear of it more often for personal lines. And umbrella not only extends the limit, but it extends, in some ways, the scope of the coverage, including it can sit over multiple coverages. So in excess, if you have a commercial auto policy with $1 million limits and you want $5 million limits, you go out and buy a 1 million or a 4 million excess 1 million policy. So that just directly extends your limits for the auto policy. But for personal insurance, there's a lot of people who are homeowners and also own cars. And they don't have to go out and buy 2 separate excess policies. They can just buy something called an umbrella policy. And as an example, if they had $1 million liability limit on their homeowners and I'll say $300,000 on their auto liability, they can buy an umbrella policy at various limits, but they could buy, say, another $1 million worth of coverage. And if they have a loss in their homeowners or their auto liability, that umbrella policy will respond to either one. So it's more than just excess. It's like it broadens the scope as well.
And something that I've seen, and correct me if I'm wrong, certainly, because I spent some time in personal lines. I wouldn't say I was an expert in umbrella, but I got some exposure to it. Sometimes actually would drop down and actually fill in coverage gaps as well. So could be claims that they're not neither auto or home. So you could actually fill in gaps where the coverage isn't, I think, very clearly defined.
Yeah, exactly. I was going to mention that, and then I was afraid you'd ask me for a specific example, so I didn't. I could probably turn
I,
that around on you.
I could give an example, but believe me, it would probably take us like 15 minutes, so we won't get into detail.
Fair enough.
One follow-up I had on that is, if based on your experience working with excess lines, was it more common for the excess coverage to be provided by the same carrier as a primary, or did you also see cases where the excess was offered by a different carrier in the primary market, based on your experience?
Yeah, I guess, well, based on my experience, I would say it's usually the excess coverage is provided by the same insurer that provides the primary policy. And it's kind of considered pretty risky if you don't do that. So if you're an insurance company and you write excess on top of another company's primary policy, there's a lot of information that you don't have, and you might not even know of potential claims. So it kind of increases the latency. It just decreases the amount of information you have to price the stuff accurately and reserve it accurately. But there are cases like in the E&S market where there's just not companies willing to write certain things, so you do have to go to that market and get coverage from different providers.
Good. So yeah, we talked a bit about umbrella, but I also did mention some of the similarities with reinsurance, and I think this is actually quite interesting. Me being especially when I got to commercial accounts, I feel like I started to study insurance a bit more carefully, because you kind of have to, because it's a little bit, as less homogeneous, it's a bit more heterogeneous. So it's like I feel like no two policies are really the same. So when we think of like what are the fundamental differences between um, you know, purchasing an excess policy or excess casualty in the primary market versus purchasing reinsurance in the reinsurance market. And the example that I'll use is, if you have, let's just say, if you have a commercial insured, it's a business that requires, $6 million in coverage. There's a couple of ways that coverage can happen, and the insured will see the same coverage. Structure will be different. So the first example I think of is having $1 million in primary limits and then 5 million in excess. So it'd be like a million primary and then a 5x1. But another example is, if the primary company absorbs the 6 million, but then they decide to cede the top 5 in limits to the reinsurance market. So in my mind, at least, that the insured is receiving the same coverage. It's just that the coverage is structured in different ways. So how do you think of the fundamental differences between those two types of arrangement? The same amount of coverage but structured in an excess way versus in primary versus incorporating reinsurance.
Yeah. So I guess I generally think of reinsurance as being specific for insurance companies. But that being said, it's easy to form relatively easy to form a captive insurance company these days. So there are a lot of businesses that form a captive, so they are an insurance company. So they now have the ability to go to the reinsurance market instead of buying excess insurance. So I guess I would say the biggest difference, well, there's the kind of the regulatory aspect, where excess insurance is regulated more than reinsurance, because reinsurance is, those are business-to-business transactions, and they should involve very sophisticated buyers and sellers. Not necessarily true if you are a company that's not in the insurance business that's purchasing excess coverage. So the regulatory aspect is one, and then just your status of whether you're an insurer or a reinsurer is another. And then I do think that reinsurers have an incredible amount of flexibility in how they can structure arrangements. They can easily carve things out. how they treat expenses, carving out, certain risks or classes that they don't want. So there's basically reinsurance contracts. There's almost no such thing as a standard reinsurance contract. They're all customized. So you have a lot more flexibility if you were to go to the reinsurance market. Yeah, that's kind of how I'd see the key differences.
I would imagine that pricing is a consideration as well, because I think we spoke about this as well. You talked about the fact that expense loads, risk loads, commissions could be different regardless of which arrangement that you choose. Um, and also, I would think also maybe capacity in the reinsurance market as well. Do you think so? Would that be a fair assessment that those are a couple of considerations as well, which would determine, whether it's placed as an excess policy or, seated as reinsurance?
Oh yeah, absolutely. And companies, insurers and reinsurers, their risk appetites can kind of change quickly, and capacity can dry up in one area, and maybe on the reinsurance side, but not on the excess side. So yeah.
Yeah. No, something else that I thought of, and so when I was in commercial lines, I spent 4 years in commercial lines. I spent, well, technically six if you include my specialty, but in terms of like the core commercial lines. So I spent 2 years in commercial property, sorry, two in GL first, and then two in commercial property. And when I was in GL, it wasn't as much of an issue. I don't think there was as much of issues with social inflation. But when I went to commercial property, what started happening, and I just kind of heard it in meetings because we were on the same team, is that the limits started to get pierced more. So similar concept to what you talked about with inflation, with the million, no longer being sufficient. So so we would both so what we see more commonly is that you'd have like a policy with 1 million per occurrence, 2 million aggregate. You had more policies being sold that were 2 million per occurrence, 4 million aggregate, even though they were still less common. So like the question I have is, when we talk about attachment points and limits, that's obviously very key to excess casualty when you think of the excess layers. So kind of what are the key considerations in evaluating limits and attachment points for excess coverage? And are they more driven by the insurer versus the insured? Because I imagine, of course, the insured has some kind of appetite for what coverage they want, but the market itself, of course, is going to impact that in terms of what capacity and. So how do you think of that? Key considerations for evaluating attachment points and limits.
Yeah, well, so I guess there's the perspective of the buyer and the insurer, the seller. The attachment point is kind of the easy one, because it's whatever it is on a primary basis. It's kind of just very common to have $1 million limits, especially in the commercial side. So then the question is like, okay, well, how far do you want to how much additional insurance do you want to purchase? And I guess one of the key considerations is that the higher in limit that you go, the more premium you're paying for a risk load. So, there's a lot more uncertainty. So let's take an example. If you just want an extra $1 million on top of your $1 million limit, that's one thing. The insurance company is going to say, okay, there's certain risk inherent in that. But once you're going up to 20 million, 25 million, the insurance companies just don't have enough experience. There's so much uncertainty. They're putting really big risk loads on it. So then as the buyer, you have to look at that and determine like, well, how important is it? What do we think our chance of having a claim that's over, say, $20 million? What would happen to our business? Is that a survival risk for our business? And then kind of do a cost benefit analysis. A lot of times the excess coverage isn't as expensive as it can look cheap sometimes compared to the primary, because the probability of getting in that layer is usually very low. But more and more it's going up, and I'm sure companies are looking at it and doing the cost benefit analysis, whether they really need to buy this.
Would it just a follow up on that? Would it be fair to say that for the same amount of limit, the higher that your attachment point is, the lower that you'd pay, just given that you're attaching at a higher point and there's a lower probability of hitting it? Would that be a fair assessment, or?
Yeah, that kind of reminds me of like the ILF, the increased limit factor relationships, where In order to get to the 25 million, you have to go through the 20 million. So therefore, the 20 to 25 million dollar range is less probable. But you're putting out a lot of, potential. There's a lot of exposure for relatively little premium. So that's where the insurer says, okay, well, we're going to increase the risk load.
Yeah. Okay. That's helpful. Now, we talked about excess casualty, of course, being in some ways a unique line of business because given some of the high layers that you're dealing with. So what are some examples of unique risk dynamics and challenges for this line of business?
Yeah, so that is where we were talking about kind of like all of the risks are exaggerated in excess. So I don't think I actually said this, but by definition, this coverage is a low frequency, high severity line. So you don't get many claims because there's relatively few claims over, say, $1 million. But by definition, if you have a claim that's an excess claim, it's a big claim. So you don't have many claims, and the ones you do are very large. So that makes it difficult to price excess coverage accurately because you have relatively few claims to base it on. The other unique characteristic is that is the latency that I mentioned. So as an example, it would not be unusual to find out as an excess carrier that you have a $10 million claim 4 years after it happened. There could be a period where, well, there was a claim reported, but the defense attorneys who are pretty optimistic, we're gonna be able to settle this for $500,000. It goes to trial or settlement, whatever happens, and it's a really big claim. So this latency, it's obviously, I call it extreme insurance because with just normal P&C insurance, you don't know the cost of your product when you sell it, but you find out pretty quickly and you can adjust the rates accordingly. Yeah. Well, something like excess, you might find out the true cost of the policies that you wrote in 10 years. So you have to really, you have to get it right the first time. And it's hard to get it right because there's just not that much information out there. So basically all the risks inherent in insurance are exaggerated in excess, including with inflation. So I'll give you an example with inflation. So say you had a $2 million claim. So if you had a $2 million claim and you had excess coverage, $1 million would go to primary and $1 million would go to excess. Okay. And then we have a lot of inflation, and just to keep it simple, we have 10% inflation. So now that $2 million claim, say the next year there's a new $2 million claim, but it's not really 2 million, it's 2.2 million. Well, $1 million goes to primary, so no change there. And now $1.2 million goes to excess. So if you look at the difference, that 10% inflation resulted in a 20% increase in the excess. So that's one example of where the risks are leveraged for the excess coverage. Trying to think of some other risks, but pretty much, reserving, it's very difficult to reserve for because you don't have the information. So that's a risk, and the pricing. And another one would be like a scope risk. So if you think back to all the policies that were written before 1985 or 86, whenever there was some key date with respect to asbestos, before they were excluding asbestos. I might not have that date right. But there were a lot of policies written, including excess policies that covered asbestos, where nobody even knew that was a risk. So essentially, if you think about the policies that are being written in excess today, there's coverage being provided for risks and losses being incurred for risks that nobody even knows about. And so that latency is kind of the reason that it leverages that scope risk.
When you mentioned the inflation example, the leverage inflation, I was thinking, I think it was exam 8, one of the exams where you had to do the expected value and come up with the inflation. And I think that example was kept coming up. So it's a good reference there, good callback. So yeah, those are some examples of environmental factors and also functional things, pricing, reserving itself. When we think of specifically exposure attributes, I'm curious to know, are there any unique exposure attributes that drive claim experience for excess casualty? So for instance, if you think of something, a simple example would be like property cat claims. Of course, if you're a coastal risk, you're probably at a higher likelihood of being exposed to cat losses. So is there anything unique to excess casualty? I imagine that to some extent it would just follow the underlying liability line of business, but is there anything unique to excess, that something about a particular risk that may increase the likelihood of an excess claim?
Yeah, you know what? That's a tricky one, because I do like, the easy answer is that it kind of follows the exposure from the primary.
Yeah,
But
yeah.
there certainly are some, like back to that fuel truck delivery. The probability of having a $200,000 claim for this fuel truck delivery might not be that much different than I don't know, just a regular truck. But the regular truck doesn't have any chance of a $25 million loss because it's not going to blow up somewhere. So that would, something like that. There probably are unique risk profiles for certain exposures where they have an increased probability of exceptionally large claims. But if you just looked at their primary, kind of like smaller claims, they might not necessarily be completely different.
Mm-hmm. Okay. Yeah, that's helpful. I mean, and that's interesting to know, because my initial assumption was that it just followed the primary, but it's good to know that you could have, a couple of cases where there could be some unique exposure attributes there. Now, something that yeah, go ahead.
Yeah, sorry. I think in general that is the assumption in pricing a lot, because there's even like some of the modeling, the curve fitting, it starts with the information that you know. So losses that are, say, $0 to $1 million are the basis for extrapolating these extra large losses. So that kind of is implicitly assumes that those characteristics are uniform throughout the entire range of values. But you kind of challenged me to think of an example where that's not necessarily true, and I could see that assumption is probably, not always the case.
Yeah, but I think it also makes it interesting. There's only one reserve review I was involved with for umbrella, and I think I was briefly involved with pricing for excess on a more limited basis. I think it was within the context of specialty, and to your point, it does make things a bit interesting because it's not just something linear that you're applying a very simple equation. You're making assumptions, and there's a lot of art, I find, too, when you get into the excess realm. It's not just like science. It's not just like formulaic and equation based.
Yeah, definitely. And if you find that it is just formulaic and equation based, you're probably going to be in for a big surprise at some point.
Yeah.
Just, actuaries are very good at modeling things, and it can be very humbling when you're talking about, trying to model excess insurance, because there's so little information, and it's important for actuaries to draw conclusions based on incomplete information. That's part of the art of what we do. But you really have to have the humility to realize that, these estimates could go all sorts of ways, and not to get too overconfident, and not to communicate them in a way that's overconfident, because management, if a portfolio looks profitable based on the actuary's estimates, management's going to be happy to kind of double down and start writing more business, and then you don't want to go back and find out, like, well, it was a really cool model and it took a long time to learn and everything, so I had too much confidence in it because it was fancy, sophisticated model that only a handful of people can understand. So it definitely is a balance between the art and the science in pricing and reserving for lines like this.
Yeah. One thing that might be helpful, and I think we spoke about this before, you told me that you did a post at one point where I'm not sure if it was video or short form, it might have been video, where you talked about the life cycle. You kind of broke down the life cycle of an excess program. So talk us through that. I think that might help us to understand as the evolution of how the claims, where the direction in which they move, and kind of some of the key considerations there. So how would you describe the life cycle of an excess program?
Yeah, so I don't actually have a video, but I am working on one. So the example that I want to give is of an unprofitable program. And the reason I want to pick on, I'm kind of going to pick on excess casualty here and talk about a program that you know, is unsuccessful. Because if I talk about one that is successful, it really doesn't highlight any of the risks. It's just a happy story. So the timeline, suppose you're an insurance company and you want to start a brand new excess casualty program. So you don't really have any information. So the sources of information that you can use, you could go to your primary book, and kind of what we are just talking about, you can look at the experience from your primary book and then extrapolate to higher layers. And when I say extrapolate, you know, actuaries have methods to fitting curves to the data, so they can fit curves to severity data, average loss size. And if the biggest loss you have is $1 million, that doesn't necessarily stop you from extending that curve, extrapolating it into higher layers, and you can use that as a basis for pricing for your program. There's also places like ISO, Insurance Services Organization, that have ILF curves that you can use. But it's generally hard to find industry data for exposures like this. So you're beginning your program, you're kind of flying blind, you're writing policies, you know, you get this new program, a little bit of having your fingers crossed and just, you know, hoping that your assumptions are valid. Well, for the most part, this program is going to be in a honeymoon period for a couple of years. The claims aren't really going to come in. So it takes a long time for the claims to come in. And say you're 1 year after the beginning of the program, you might have a few claims reported. And of those claims that are reported, you may or may not have any type of handle on what their potential value could be, because a lot of these big claims just take a really long time in the discovery process. So point being, after a year, your program is going to look very profitable. All premium, hardly any loss. And then the actuaries are tasked with coming in and determining what the ultimate loss ratio is. So that's going to determine the profitability of that program in year one. Well, as a reserving actuary, they need information. If they have no information, they have to more or less default to the original assumptions that underlie the pricing. So you have a little bit of this circular logic going on, where the reserves are set based on the original pricing assumptions. So at the end of the day, in the absence of actual claim information, after a year, your program is as profitable as you predicted it would be, because it's just the way that everything works. You're relying on your initial assumptions. So it's a self-fulfilling prophecy. So what happens year two? Program looks pretty good. Well, you might start increasing premium a little bit. And again, at the end of year two, you're probably not going to have much information on claims. So it's still going to look really profitable. So that honeymoon period can go on for a few years. It could be abruptly stopped if you find out, like, whoops, we got a $25 million claim. Like, whoa, this is serious. We're going to have to go back and reevaluate things. But there, in my example of this unprofitable program, there's certainly a chance you get through a few years with, you have big claims, but you just don't know about them. And you're defaulting to your original assumptions, you're increasing premium, you might even be lowering rates because the program looks so profitable. So, you know, everything's headed in the wrong direction, but you don't know about all the losses you have incurred. So after a few years in this kind of sad example, let's say you get to about 5 years in the program, that's when you have a chance of actually knowing about some large losses, and then saying, well, this probably wasn't as profitable as we thought. We need to increase rates. And then you get into this cycle where you're increasing rates, and essentially tightening the belt. So you're being more selective on risks. So you can get into this cycle where now you're reducing your premium, because you're increasing rates and kind of some of your best policyholders are leaving. So premiums going down, all the while, all the losses that you didn't know about are starting to come in. So from a calendar period's perspective, the program went from all premium, no losses, to all losses, not as much premium. So, it can look abysmal. And, that can take anywhere from like 5 to 10 years before a company can really assess the profitability of an excess program. So that's a life cycle, one where it starts and then ends, kind of drives over a cliff, just to, emphasize the risks involved. The latency is a real key one, and the fact that there's not a lot of losses, but the ones you get are large and they're latent, so you don't know about them for a long time. So it's very risky coverage to write. And that's why you don't typically see an insurance company startup saying, "Hey, let's just write some excess insurance." Mm-hmm. It really needs to be with a bigger carrier that can diversify, benefit from the diversification of the risks. The other thing that I wanted to mention with the how all the risks are exaggerated with excess is there's something called process risk. And process risk is the type of risk that you can diversify away from just writing a bunch of policies. And that's kind of how that's essentially the model of insurance and how it can provide value. Well, with excess, it's hard to get a portfolio big enough and enough exposure and claims to really diversify away the process risk. So that's another one that's just kind of stands out.
Mm-hmm. That's a really good illustration. And as you talk about some of those unique risks, obviously reserving is very key in that. So, what are some of consider in light of this risk and this inherent volatility, what are some key considerations for actuaries who are doing reserving for excess casualty?
Yeah, I'm sorry. Can you ask that again?
Oh yeah, sure. Yeah. Just in light of the inherent volatility and the riskiness that we discussed throughout this cycle here, what are some key considerations for actuaries who are reserving for excess casualty?
Yeah. Well, kind of going back to what we said before, or what I said before was not being overconfident in the modeling. Really stepping back and asking yourself, okay, what are we doing here when we're reserving? We are being tasked with projecting what's going to happen in the future. It's not really possible to know what's going to happen in the future. You have to wait for it to get there to know. And, actuaries and clever people have figured out that, well, you can look at the past and use that to determine what's going to happen in the future. But when it comes to something like excess insurance, there isn't much of the past, and it changes more than a normal primary line of insurance. So there's not much to go on. And it's in a state of flux. So just kind of having the humility to know that these regular reserving models and loss development and so forth, you don't want to be overconfident in the results. So that would apply to kind of pricing or reserving actuaries. And, actuaries can kind of get in this weird circular logic cycle between pricing and reserving, where the reserving actuary is using pricing assumptions to come up with ultimates. And then, okay, we have an ultimate loss ratio now. And somehow that finds its way into the pricing.
Yeah.
So it's like, where's the, chicken and the egg problem?
Mm-hmm.
So that's something for actuaries to look out for. Yeah, and the fact that, as I mentioned, it's harder to diversify away the process risk. So that's something, and all these exaggerated risks is something that actuaries have to look out for when they're trying to determine a risk load. Because at the end of the day, insurance companies are taking, very large risks for relatively low premium on some of these exposures. And yes, the probability of having a claim, an excess claim, is very low. But when you have one, they can be really big. And you can, like I said before, you can be writing exposures that you don't even know exist, but they will be covered in the future. So, actuaries really need to be aware of, step back and look at the big picture when it comes to excess. And I guess the one thing that I feel kind of strongly about is, as a reserving actuary, you do have a responsibility to very accurately communicate the results and all the caveats. I know sometimes it feels like, you're like weaseling your way out if you have all these caveats and limitations on your estimates. But on the flip side, you don't want to present them in such a way that a company is going to make a decision that is going to get it in trouble later. Specifically underestimating reserves just because you don't have enough information. And then the company's making critical business decisions, they increase their exposure, and they're not going to be happy with you eventually if you did not adequately characterize the risks involved.
Recently, you touched on risk load. I know we talked about risk load a few times in this episode, and I know that there are going to be people who may not be familiar with the expression. I think when I think of it in the property sense, based on my recollection, I remember it talks a lot about aggregation, like you take a cat risk, like aggregation of, concentration risk. So in some ways, compensating for that. When we think of, and correct me if I'm wrong on that, that's my recollection. But when you talk about liability risk loads, is that more kind of compensating for things like mass torts and, again, similar kind of concentration risk, or is it, another way of saying it is that when you think of risk loads for liability, like what are those incorporating?
Yeah, I think of them as just reflecting the fact that the insurance company is assuming risk that it doesn't even know about,
Mm-hmm.
and it needs to be compensated for taking that risk. So, just kind of like the traditional investment advice is you want your expected return to be proportional to the risk, or you want the best return, but there's an expectation that there's a proportional relationship between risk and return. Well, excess insurance is another one where it's exceptionally risky. So we want to make sure we get an exceptionally good return. And how do you do that? Well, that's reflected in the risk load, by bigger risk load.
That's helpful. And there's one more thing I want to touch on regarding reserving is what are some of the most common methods you're seeing? I know first one that maybe comes to my mind is 𝗵𝗃, something when you don't have early emergence, but between some of those traditional methods and or is it more like individual claim estimates? I know that's also something that companies do in a more proprietary way. So like what are some of the most common reserving techniques within the excess space?
Yeah, well, despite everything I said, the things like the Bourne-Hüter-Ferguson and the development methods are still pretty commonly used and pretty prominent. And there's some other methods like the single parameter Pareto. There's a couple of good papers written on that. That's one I kind of alluded to it before, where it's fitting a curve to the severities. So you can do a frequency severity method, where the severity is determined by something like a single parameter Pareto model. And the frequency, that's usually a little bit easier to get at, determining your ultimate counts. So in general, frequency severity methods are used a little bit more heavily. And then, to spice up a frequency severity method, you can do modeling on the severity side, using something like the single parameter Pareto. Other than that, kind of the traditional actuarial methods are used. But in a way, I feel like that is to give everybody maximum flexibility in the selections. So like the 𝗏𝗏 method, and it would be very common if you are starting up a new program, year 1, year 2, your ultimate loss is probably going to be based on the 𝗏𝗏, with the expected loss ratio based on your whatever underlied your pricing assumptions. So that's kind of like the self-fulfilling prophecy part of it. But once you have a little bit more data, and you're kind of stuck with, let's face it, if you don't have any information, there's nothing to work with. So there's no magic, there's no crystal ball that you look into and see the future. You just kind of have to be have the proper humility about it and say, okay, here are the assumptions we're making. Actually, the one thing that I like to do, and I wouldn't mind seeing this done more often, is especially in lines where you just don't have very much information. So as a reserving actuary, to really focus on articulating and communicating the assumptions inherent in your estimates, because you have the assumptions, you have the data, you have the method. Between those three things, that's where you're going to get your estimate of ultimate. You can present your assumptions in such a way that say, especially something like a startup program, and you're relying on the 𝗏𝗏 method, you should be disclosing your assumption of how did you get your expected loss ratio, because that is really driving the result. And when you share your assumptions and say, hey, everybody, does this seem reasonable to you? Because this is what is driving our results. It kind of gives everybody an opportunity to at least see what your assumptions are and possibly weigh in on them, without getting into all the actuarial methodology.
Yeah, that's key. And can't think of a better note to end on. I think this was very insightful, and I certainly learned a lot about the line. I don't have a ton of practical experience with it, and certainly not as much as you, and just looking forward to sharing this with the community. And again, Don, just want to thank you for your time and for sharing your expertise.
Thank you very much, Dominic. It's been great being your guest, and maybe we'll have a chance again to talk in the future.
Yeah, where are you again? You're in is Philly, you said?
Yes, I'm outside of Philadelphia.
Yes, we'll be sure to keep in touch if I'm on that side. And same if you're in California.
Yeah, awesome.
All right, Don. Have a good one.
All right, thanks. You too.
Take care.